So over the weekend, I did another one of my Sunday 3-hour sessions with the One Rental at a Time community. And one of the topics that came up most frequently was recycling capital. So what I thought we should do is talk to Anna REI Mom Kelly, who has been a part of these Sunday sessions before, and ask her how important recycling capital was. And then more importantly, what, if anything, we would do different today, because I think the rate environment is vastly different. But Anna, welcome to the show. How you doing?
I'm doing great. Always so good to be here with you.
Yeah, thank you for you are our you the reason we have our millionaire sessions is because of you. You said, "Hey, let's do this weekly." And from there we've added more, but thank you so much for that initial idea.
Oh, you're so welcome. It's my pleasure to be here every week. I love helping your viewers, and I love seeing the comments and making an impact and helping you to change lives with the wisdom and the experience and the failures that we've had to
Yeah,
help you to do it faster. So it's my pleasure always.
awesome. Well, so I want to go back and again revisit our story, right? Our stories start a little bit, or at least mine does, before the Great Recession. Yours kind of right before, and then really during. But I want to talk about how important recycling capital was for your journey first, and then talk about the
Yes.
ways that you've recycled capital, and then acknowledge that today might be different. So, was recycling capital an important part of your journey?
Absolutely. Yes. Because here's the reality. I started out without any money. And so when you start out without any money, you've got to figure out how do you get the first one? And then once you build some equity, the only way you're going to be able to get the next one is to come up with money down. And, some of that's using other people's money, but I really wanted to own things myself. I didn't know a whole lot about hard money lenders or private money lenders. And quite frankly, when I was really wanting to really scale, it was post Great Recession, and a lot of hard money lenders had gone out of business. So I was relying on forcing values, kind of that Burr method, buying it, renovating it, creating equity, refinancing it to recycle that capital to pull out the cash, and then repeating it. And then I would take that equity that I had created and I would use that as the down payment on the next one. And I did that over and over and over again. So most of my recycled capital was really equity that we had built in our own properties, and then recycling that equity either through second mortgages, through lines of credit, or just using the collateral as a down payment for the next one.
I think those are all important because again, they're all things that maybe people don't realize. You can get equity lines, seconds on rental properties, right? A lot of people think
Yes.
that's only an owner rock. You can. The rates are higher, but
Yes.
if you have enough equity, and let's say that the banks are actually lending, right? Because again, there's a lending cycle today. They're obviously more
Yes.
nervous than they were when we were doing this. Um,
Absolutely.
but you've also, I guess, later in your journey, I believe you've executed at least one or two 1031 exchanges. Is that correct or no?
Absolutely, yes. I've executed a couple of them where I decided, you know what, it's time for me to sell a property for whatever reason. And instead of just taking that cash and sitting on it or paying a capital gain, ideally we want to look for a 1031 exchange that allows us to avoid paying the capital gain that we've made on the property that we're selling, and then roll that right into another property. So I've done a few of those over the last couple of years, and those have gone really well. But then also, Michael, I had a lot of other properties that I had bought with an intention to hold for 20 years. But I saw that we're at the top or nearing the top of an economic cycle. And I saw prices that I felt like were disconnected to value over the long term. So I sold quite a few properties. I looked back yesterday, I sold 34 units in the last 2 years on properties that I had planned to hold. And I couldn't find 1031 exchanges. But you know what? I found other ways to use tax benefits like bonus depreciation to offset the capital gain so that I didn't pay it even without a 1031. But I recycled almost all of it back into buying more properties, in that same tax year. So when I sell, I'm recycling capital just like if I'm, doing a 1031.
Awesome. The other thing that we should at least acknowledge and put on record, when we were recycling capital in our journey in the 2000s, it was a rate environment that maybe was flat to slightly down.
Yes.
I think we need to acknowledge, if you're in this journey, and a lot of people on that show Sunday, they got one or two units, they bought in 18 or 19 or 2020. They've seen this huge gain in value because of appreciation. But obviously now
Right.
they're looking at, how do I get this capital, because rates are different, right? They have
Yes.
some of them have a mortgage rate sub 4. I think somebody said sub 3. But if they're going to
Mhm.
go get us, they're going to go do a cash out refi, which was important for me, it'd be silly because it'd become an alligator almost immediately. So what would you
Yes.
do today if you were kind of starting your journey? Maybe you started in 18, you've got two or three. Where would you be looking to perhaps recycle capital, or maybe that's just not an option today?
Yeah, I think it really comes down to kind of what are your financial goals and keeping a long-term perspective with real estate. Because if you're only looking at what is happening today and you think it's always going to be that way, you might get disappointed or you might make different actions. Understand that this is a cycle, and this is a very strange cycle. We haven't seen this happen in our adult lifetime,
Hmm.
right? Where
Hmm.
interest rates have just gone crazy. The Fed is fighting inflation, and so you've got top of the market values at the same time as top of the market interest rates. The reality is that makes it very difficult to cash flow today compared to a
Yeah.
few years ago or even, after the Great Recession. And so if your goal is cash flow, then you going in to take equity out and increasing your mortgage payment by a big amount that decreases your cash flow goals is really counterproductive to what your goals are for cash flow. So
Mhm.
you might be in a different position than somebody that says, you know what, I don't really need the cash flow today, but I really need the equity today so that I can find something that allows me to produce more cash flow, or because I'm patient and waiting for growth on the 4 years, 5 years, 10 years from now. So your answer really depends on where are you in terms of your financial journey. Is your job secure? Do you have a spouse that's working, that even if we go into a recession, and you have very little cash flow because you pulled equity, you're going to be okay. If you're relying on that cash flow from that property and you max that equity with a big payment and you have very little left in cash flow, and that's going to put you in a bind if somebody doesn't pay rent, or if somebody moves out, then that would be a really unwise thing to do. I would be patient, keep the equity there, and find other ways to get into properties without your own cash, and then wait till rates come back down before you try to pull out that equity.
Yeah, when I kind of look back at my scenario and try to replay it today's environment, I certainly don't execute cash out refis because again, I made that mistake with Norris Drive, creating an
Right.
alligator. I wouldn't do that. I wouldn't do that ever. To me, I think the answer again, right? Full-time employee, working all over the place, didn't have a network yet because I wasn't doing that in year two or three. I think what
Right.
I would likely get, because again, the equity spread was there. Because again, when I started buying, that we had a good run as well. I would probably do the equity lines, or credit
Hmm.
lines, whatever you want to call that. Even though they're expensive, I think there are some people quoting 9 or 10%. That would just be
Yeah.
my hurdle. And again, my plan has always been, because I did use my home equity line a couple of times over the journey, was
Yes.
I would have to pay that off in a year or less, right?
Right.
Whether that's a burr or something like that.
Hmm.
It's trying to take an honest assessment of where we are today with my history. I wouldn't
Yeah.
cash out refi. I would probably do an equity line, because again, I was in growth mode. We both had tech jobs. That's
Right.
probably what I'd be doing today if I had to, if I was honest with myself.
Yeah, the only thing that I would just to kind of show the other side of this, right? The one thing about an equity line when it's a commercial equity line, you have to be really careful to understand what the terms of that line are, because what we did see post 2009 was a lot of banks pulled equity lines. So they
Sure.
said, "Hey, if it's a home, we can't pull the line," right? So a home equity line of credit, it's there forever, however long that term is, and they can't call it as long as you're making payments. But on a business equity line, which is basically a commercial line of credit collateralized for you real estate investors by a piece of real estate, the fine print in almost, and I think maybe every commercial line of credit I've ever seen, surely the vast majority say that they can call that note due at any time. And what they do is they want annual financial reports from you, just like when
Yes.
we're buying commercial, property. And they will look at what they think the value of your property is. They'll look at whether you're paying, and they'll look at whether the property collateralizing that loan has enough cash flow coming in consistently to cover your first mortgage, all your expenses, and that line of credit. And if they're not comfortable for any reason, even if it has nothing to do with you, but their bank is in a situation where they can't afford to
Yes.
have these lines outstanding, they can close the line. Now, hopefully they would close the line and let you keep paying on it. You just can't use any more than what you have outstanding. But I did see post Great Recession banks calling them due, like you have
Yes.
90 days to pay this off. And if you're in an environment like we are, where banks are really tight right now and they're saying, hey, we're only going to give you 65% loan to value, then if you've got a first and a second and you've only got maybe, 5 or 10% equity left in there, you may not be able to refinance that line of credit. So I just want to caution you there. Don't take that line and then max it out on something and not have any liquidity left in case that line of credit is called. It may be a low probability that it's called, but Michael, after what we saw in 2009 and 10 and what we're seeing with the
Yep.
banking system right now and with lending, I'd be really nervous to pull a new equity line of credit unless you really needed to. I'd
No,
rather see you go find other people's money to
sure.
do your investing with.
Yeah. I think
Yeah,
that's
I think that's
wise.
why.
Wise decision. Again, when I think about where I was year 3 or 4, I didn't have the network. Wasn't doing any of that. I would probably get the equity line, but the right answer, like you've said, is to skill up, realize that private money, joint ventures, these other avenues can take you a lot farther. And again, we are in a very interesting time, right? This environment may go on for another year, another 18 months, but you and I have
Right.
seen real estate cycles and more importantly, lending cycles play out all the time. This one
Right.
too will pass.
For
But
sure.
it's still about making positive step forwards. Don't get over
Right.
leveraged. Don't get negative cash flow. The best deal many times is a deal you don't do. Don't beat up your spreadsheet. Just keep doing
Yeah.
the
Be
work and then,
patient.
yeah, be patient. There you go.
Be
Be patient.
patient. And I'll say this too. I mean, we kind of alluded to it at the beginning, but it might be that you look at your portfolio, and I highly recommend that you look at your portfolio no less than twice a year, hopefully every quarter, right? But no less than twice a year. And you look at all your properties and you say, are they still performing the way that I thought that they would? And is keeping it and keeping the equity in that building for now the highest and best use of that property? And I will tell you, I just made a decision to list a property today that I bought a year and a half ago that I planned to keep a really long time. But things have really changed in the economics of that property. For example, it's a coastal property and my insurance is skyrocketing and the taxes have gone way up. And so, it no longer makes as much sense as it did before. I'm choosing to sell that property to take my equity out and recycle it by saying, give me the check. I'm going to have all this cash, and now I'll use that recycled equity from the sale to go buy another one. So don't feel like you're failing if you choose to sell something. Sometimes it's wise to sell before you thought you would, because it's an alligator. The equity can be better used somewhere else, and it's just not performing as well as you thought. So a sale is not a bad thing. And if your only other options are negative leverage, where it's reducing your return significantly by having a higher interest rate loan, then sometimes it's better to just sell than to hold what becomes an alligator if you tap out all the equity.
Yeah, well said. Anna, do me a favor. Where can people follow you?
Great. You can find me on your show every week. You can find me on my website at reimom.com if you're interested in coaching or consulting.
Thank you so much.